Hi, welcome to Chapter 2. Today we'll be talking about investment alternatives. And there's a couple of markets that we want to go over that when we're talking about financial assets. Now, non-marketable financial assets, which something that could be direct ownership, which is a claim between an issuer and an investor, usually very liquid or easy to convert to cash without a loss of value. And the most basic example is a savings account at a bank. But this could also be bonds, certificates of deposit, money market accounts. So they're non-marketable, very safe assets. And because they're very safe, they generally have a very low return. Now, money market securities, these are marketable securities that are claims on saleable, negotiated items in the marketplace, but very short-term liquidity, low-risk debt instruments, primarily government and government agency instruments and highly rated private corporations. And they put together these very safe vehicles to make what's basically money market mutual funds. And they can make the money market mutual fund in treasury bills and high secured government agencies or commercial paper for very secure corporations. Now, capital market securities, these are securities that have generally maturities greater than a year. So stocks, long-term bonds, things of that nature. They're definitely more riskier than money markets, and they don't really hold, money markets will hold a peg to a dollar, so you generally will not see any price fluctuations in your investment, although it is possible, but very rare. That was a big worry in 2008 that they would break the dollar peg on those money markets. However, capital markets are going to be more risky, and they're going to fluctuate more in the per share price of whatever you purchase them at. Typically, fixed income securities, they're going to have a very specific payment schedule of interest and a specific payoff date of the principal, but the price will change day to day in between. Now, just some basics in bonds. This class is not going to focus primarily on bonds. We have a whole fixed income security class that talks about bonds in a great extent, and we also have a capital markets class that also talks about bonds. So this course will focus mostly on stocks. Now, when a bond is issued, buyer of a newly issued bond will get what's called, they call it a coupon bond. And the reason they call it that is long ago, before computers were what they are today, you would buy a bond and issue a book of coupons. And every month or every 6 months, depending on the frequency of dividends, you would rip out a coupon from the book and bring it to your bank and you'd get your interest. And that's why they call them coupon bonds. So they're very defined rate of interest that they pay that's fixed. And they agree to repay the principal at a later date, 10, 20, 30 years. Now, bonds are commonly known as fixed income securities, so you know what your future cash flow are, and you know if you're borrowing money, then you know what interest and principal payments you have to make. Now, if you sell before the maturity date, so if a bond issued $1,000 is going to become due in 10 years, you get that $1,000 back or have to pay that $1,000 back, depending if you're the buyer or seller. However, if you trade that maturity between that 10-year time frame, it could be valued at any price because it's going to be in relationship to the new bonds and what the interest is paid on the new bonds. So if the new bonds are paying a higher interest, your old bond isn't going to be as valuable, so it may trade below $1,000. And vice versa, if your bond has a higher interest rate than the current bonds, you'll trade at a higher rate because they want to make them comparable. So whatever you're buying, you're going to get the same return on it. So that's why the price fluctuates. Now, bonds are quoted as a percentage of par. So if you have a $1,000 bond that's selling for $900, that's 90% par. If that $1,000 bond is selling for $1,100, it's 110% of par. So it's quoted as a percentage of par. And the bond buyer must pay the price of the bond plus any accrued interest since the last interest payment. So the bond, you think of them, if it's a 6-month period and you buy it in between that 6 months, whoever you're buying it from is going to pay you the accrued interest that hasn't been paid out yet. Now, if a bond sells above the premium, above the par, it's called a premium bond. If the bond is selling below par, it's called a discount. And most bonds, par value is $1,000, although that could be different, but most are $1,000. So a zero coupon bond is a coupon that didn't come with a coupon book. There's no coupons to the bond, which means you get no interest. But you buy the bond at a discount. So savings bonds are typically like this, where you could buy a $100 savings bond, but you're only paying $50 for it. And when the saving bond is due at maturity and you bring it back to the bank, you get the $100. So you get the principal and the interest back at the end, and no interest for the life of the bond. And that's why they call it zero coupon, because you wouldn't get any coupon books because you're not getting any interest. And so it does lock in a rate of return. And although the price of these can respond just as sharply as other bonds to interest rate changes, and they're not very popular with taxable investors because when the bond comes due, you have to pay tax-only interest at the end. And there could be a call feature. A call feature is just basically a feature where whoever issued the bond decides that they want to pay it off early, and they call the bond. And they say, hello, bond, we know we're 5 years early, but we're going to pay you off now. And that's why it's called a call feature. Now, major bonds, we have the federal government securities, treasury bills and bonds, and you have all sorts of maturity dates. These are the most common, biggest market, and it's a major type of bond. Now, the federal agencies, like Ginnie Mae, which is a housing agency, is a federal agency bond that's very secure. And there's also federally sponsored bonds. And these are, credit agencies, securities, and they're sponsored by the government, although they're not directly the government. So Fannie Mae's, Sallie Mae's, Fannie Mae's would be mortgages, Sallie Mae's would be student loans. These are have an association with the government, and they're sponsored by the government, so they're perceived to be safer, but they're not totally 100% backed up by the government. And then you have your municipal security bonds. And the municipals are state bonds, and there can be either general obligation or revenue bonds. Now, the general obligation bonds are bonds that the state just has a general responsibility to pay back. The revenue bonds are specifically tied to a project. Maybe there are bonds that money was being raised to build a bridge. So the tolls of that bridge, that's the revenues, would be dedicated to paying back the bonds and the interest on the bonds. And what's nice about municipals is that generally the state municipals, if you live in the state, can be federal, local, and state tax-free. So you get a triple tax freedom from these bonds, which could give you a fully taxable equivalent yield much higher than a corporate bond. And that's a really nice feature if you make a lot of money or in a higher tax bracket. Now, a formula for this, if you want a taxable equivalent yield, you take the tax that you're going to pay minus the municipal yield divided by one minus your marginal tax rate. That's just one formula. There are other formulas, but basically you want to get an equivalent yield. So that way you want to see how it compares to a bond that's taxed. So there's a handout from Chapter 2, Taxable Yield. So if you go to Course Documents, Classroom Handouts, on the electronic blackboard, you can pull down this document and you can see examples of a couple different formulas. I put in there the treasury bonds are state tax free, so I put a formula in if you want to calculate the taxable equivalence of a federal bond, like a treasury bill. There's also the state bonds that are both federal and state tax free. You could calculate the equivalent yield for that. And then the state bonds that are only federally government tax free. Now, the reason that we have these tax freedoms on these bonds is that the state bonds, municipal bonds, are tax free from the federal government because the states don't want the federal government interfering with how they raise money. Because if the government didn't like one state, they could raise the taxes on their bonds to a very exorbitant amount where the state would not be able to raise any money. And the same thing, the states could gang up on the federal government and tax the federal bonds and put the federal government out of business. So that's why the states can't tax the federal bonds and the federal government can't tax the state bonds. Now, in many cases, the states also give you state tax free as well because they're not missing too much revenue by doing that, and they're being able to issue debt at a much lower interest rate, which is much more beneficial for the state. So if we go to corporate bonds, their maturities can be anywhere from 20 to 40 years. There's even been some 100-year bonds from Disney and Coca-Cola, but those are a rarity. Now, they pay semi-annual interest. Some bonds will pay monthly interest, like municipals and mortgage bonds typically can pay monthly interest, but corporate bonds typically pay semi-annual interest, or every 6 months. They're callable, and the par value generally always starts at $1,000 for these bonds. So, like I said before, the callable bonds gives the issuer the right to rebuy the debt back at an early date. So say a company makes some bond issues, they become very popular, very prosperous and have a lot of profits, they may want to pay their bonds back early. Just like if you wanted to pay your mortgage off early or your car loan off early. Those are also callable debt instruments. Now, convertible bonds, when we're talking about corporate bonds, just means that you can exchange the bond in for stock. So you can convert your bonds into shares of stock at an agreed upon price. And that sometimes gives it a little extra versatility, and these bonds will have a lower interest rate, saving the company money when they issue the bonds. Now, if the bonds are issued from very risky companies, they used to be called junk bonds, but no one wants to be called junk, so they renamed them high yield debt. But basically means being issued from a very risky company. Now, for the investor, there is a bond rating agencies that help you, sort of like your FICO score. So you get a FICO score, which is your credit score. So businesses know how credit worthy you are and what they're going to charge you to lend you money, or if they're going to lend you money at all. But bonds have a similar service from the S&P. Has a service, and also Moody's Investor Service. So there are two rating services, and they rate based on the performance of a credit analysis of the company's underlying, or even governments or states' underlying credibility. And the emphasis is on the probability of default. So investment grade bonds are anything that are BBB or higher, and AAA is the highest. Now, speculative securities, a high yield debt, will have a BBB or lower, which, C bonds, they're probably not going to be paid back or paying any interest. So those are over the lowest category. Now, there was a big deal made up a few years ago when the U.S. government had their debt downgraded from probably AAA status to AA status, and everybody thought the world was going to end, but really, actually, pretty much nothing changed. So, and the rating agency said they were going to lower the U.S. debt because of the high deficit and the high debt that the country was running. So, although lately that has changed, and maybe we'll get that AAA rating back soon. Okay, securitization. This is sort of what was involved in the 2008 Great Recession that we had. Now, you can take illiquid, risky individual assets, and you can package them together in a herd called an asset-backed security. So if you were to invest in one bond, that's risky. But if you're going to invest in 1,000 different bonds in one package, now the chance of default of all these companies is minimal to non-existent. So the idea is package enough of these bonds together and it becomes safer. So that was the idea against securitization. Unfortunately, when they securitized mortgages, they were considered ultra safe because at the time no one felt that housing prices would go down, and that would always keep them very safe, because if someone got into financial trouble, the bank could take the mortgage back and resell it and reclaim all the money without a problem. But when housing prices started to drop, these asset-backed securities on mortgages became very risky, and there was so much money tied up in these, and so many, credit default swaps and different retirement funds and mutual funds and personal investors all tied up in these municipal market, that when this started to look very shaky, that really created a panic on Wall Street. Now, you could also take any type of securities like auto loans, credit card debt, small business loan, leases, and you can repackage them as securitization. And you can securitize them and sell them. And what it does is help to really move the money around. So that way, think of a bank that has, just enough money to make 100 mortgages, and then they're done. But if they can take those mortgages and sell them to somebody else and keep a small profit in each mortgage for themselves and get all the money back that they lent, now they can go and issue another 100 mortgages. So it just takes the money, repays the bank for the monies that they lent and brings it to the capital markets for the average investor to invest in, and refunds the bank so they can make more loans. And the banks make much more money on the fees of establishing the mortgage than holding the mortgage. So banks were making a lot of money just turning these mortgages and writing as many mortgages as possible. And once it was securitized, the bank didn't have to worry about default because now they were divorced from the loan. And that's why they kept, the mortgage brokers and banks kept writing riskier and riskier loans, because they didn't have to worry about, being on the hook if the homeowner didn't pay. It was now the investors were on the hook for that. So that's sort of like that process of securitization just spun out of control as people made very bad and unethical decisions in the loans they were giving, loans to people who should never have had loans and never had a chance to pay them back. And exotic mortgages, interest-only mortgages, and zero interest, and balloon, and no payment mortgages. All these crazy mortgages were created to, get the worst possible people involved in owning a mortgage that surely would not be able to pay after 6 months to a year. And that sort of sparked the whole Great Recession we had. So securitization is good if the risks are known and the proper protocols are being put in place. However, if people treat them as a dumping ground, they become toxic. And a lot of these mortgage-backed securities became toxic. But securitization is a good way, on a good day, done right, a good way of moving money from investors back to banks so they can make out more loans, which can help expand the economy and do a great service to the overall economy. Now, and a lot of these securitization products are still good today. Even mortgage-backed securities are better today, much better today. And they tend to have higher yields, shorter maturities, and better investment grades. So I think the industry learned a great deal. New laws were written and new safety guards were put in place. So securitization is back to being a more safer type of investment. Now, let's switch over to equities. Equities is another way of saying stock. So if you own stock in a company, it means you own part of that company. Now, it doesn't mean that you call the shots. You need 51% of the stock to call the shots. Otherwise, you're just sort of a very small owner. You can't walk into McDonald's after buying one share of McDonald's and saying, hey, I own this company, give me some free hamburgers. No, that will not work. But if you own 51% of the company, then you most likely could do that. So it's all about your voting rights. And if you have a majority, then you control the company. So control of the company goes to whoever has the majority of voting shares. Now, this has a limited liability, though. You can only lose as much as you invest in the stock. You're not personally liable for any problems at the company. You're sort of a silent owner. When you own the stock, you are not responsible for anything outside of what you paid for that stock. So you can't be held responsible for other problems at the company. Now, there are other types of stock. We have preferred stock, which is sort of a hybrid between bonds and stock. And what preferred stock is, it's stock that acts like debt. So the advantage to businesses is if you issue preferred stock, you never have to pay it back. Like bonds have to be paid back in the maturity date. Preferred stock doesn't have to be paid back because it's like stock. You issue it, you get your money, and you never have to pay it back. However, preferred stock, you do have to pay dedicated dividends that are known and fixed in advance. So dividends have to be paid on preferred stock, just like interest has to be paid on debt. So think of preferred stock as bonds that never mature. And sometimes the preferred stock can be convertible into common stock, and they can even carry a variable rate. And preferred stock, they can always buy back their preferred stock to cancel it out at a later date, but they don't have to. So it's a great way to raise money without having any deadlines to pay back the money that you raised. Now, common stock is a claim on income and assets of the company. The par value of common stock is not like the par value of bonds. It is not meaningful anyway. It's economically insignificant, and it's really just an accounting standard. The book value of a company refers to the accounting value per share. And the basic accounting formula, assets minus liabilities equal equity. So if you take the total assets of the company, you minus the total liabilities of the company, you get the equity. Divide that by the number of outstanding shares, and you get the book value per share. And the stock price always trades above the book value. Now, the market value is just whatever the current price of the stock is. So if we say market value, we mean what's the current price of the stock. Now, dividends, cash dividends, are paid by some companies will pay cash dividends. And to get a dividend yield, you simply just divide the dividend payment by the per share price, and you get the percentage of the stock that's paid as a dividend gives you a yield of return. So a $1 dividend on a $10 stock is a 10% yield. Now, the payout ratio is against earnings. So if you pay a $1 dividend and the earnings are $2, the payout ratio is 50% of earnings is paid out as a dividend. Now, with dividends, you can't just buy a stock the day before the dividend is due for payment and expect payment. There definitely is. They have a declaration date, the date that they declare the dividend, and then they have a date of payment. But in between those two dates, there's the ex-dividend date and the holder of record. So you have to hold the stock on the ex-dividend date, and then you are, and you make sure you hold the stock to become a holder of record. So that way it's written down in a that you're the owner of the stock at the time the dividend is divorced from the stock, meaning anybody that buys the stock after that date will not receive the dividend. And even if you sell the stock after that date, you'll still receive the dividend because you just have to be recorded as owning the stock on that day and you'll receive the dividend. And that's why often the stock moves lower the day after that period is over because the dividend is no longer part of the stock. And this happens before the payment date. So you can't buy a stock the day before the dividend and expect to be paid a dividend. Now, that's a cash dividend, often called a stock dividend. But there are straight stock dividends, which is payment in stock. So they can give you a 10% stock dividend, which means if you own 10 shares, you now own 11. However, the price is adjusted, so you don't really have any additional money. And if you were to get 100% stock dividend, we would call that a 2-for-1 stock split. So you say you have a $10 stock and 100 shares. After the 2-for-1 stock split, you have 200 shares, but now it's not a $10 stock, it's a $5 stock. So overall, you're going to have $1,000 of equity value, but you're going to have a different allotment. So instead of having 100 shares at $10, you have 200 shares at $5. So this is what I mean by you're not really getting any money, you're just getting more shares at a lower price. So the book value and the par values, they all change once there's a stock split. The PE ratio is the ratio of the current market price of equity to the firm's earnings. So it's the price of the stock per share divided by the earnings per share. And it gives us a multiple of how many times the stock is trading, how many times earnings. So if you had earnings per share of $1 and the PE is 15, that means the stock is trading 15 times earnings. So if the earnings are $1, the stock price must be $15. Now, investing internationally is an important thing. So you could invest directly internationally by buying stock of foreign companies on foreign exchanges. You can buy Canadian stock on the Toronto Exchange, or you can buy, so many countries have their own stock exchange that you can access through your broker and buy those stocks directly. But you're going to be faced with a currency transaction. So your dollars would have to be converted to, say, euros, and euros would be used to buy the stock. Now, but many firms choose to list themselves in the U.S. market. So many foreign firms like Toyota, Honda, Sony are listed on the New York Stock Exchange. You could buy it just like any other stock in dollars, get paid in dividends in dollars, not worry about the foreign exchange. And so a lot of foreign companies want to make their capital, their equity, more accessible, so they chose to list them on the American exchanges. And in some cases, they could be purchased as what's called an ADR, American Depository Receipts, which is a way of using banks to securitize and compensate for any currency fluctuations. So you, as a domestic investor investing in a foreign security, everything looks like to you that it's in dollars and you're isolated from any currency fluctuations. Now, derivative securities is another type of security, which is the assets derived from another security. So stocks can be the asset and stock options can be the derivatives. Oil can be the asset and future contracts can be the derivative. So these derivatives are just a contract that an exchange develops, and they could be options, futures, swaps, or forward contracts. And they standardize these contracts in the way that they guarantee performance. So the exchange, you never see the other side of the party. So the exchange sits in the middle, and they guarantee performance. So the people who promise to be on one side of the future contract will be married up with someone on the other side of the future contract, and the exchange in the middle will make sure that they'll guarantee that whatever is agreed upon will come to fruition. So derivative securities are complex securities, and they'll be talked about later in a later lecture, but it's just another type of alternate investment. Now, as a small investor, you can invest in stock options, but you cannot invest in financial futures. Those are really for institutional investors and bigger companies and corporations. Now, options, they're traded on exchanges. And they're created by individual investors, not corporations. So corporations don't receive any benefits from stock options created on exchanges. Don't be confused by company and reward plans that have stock options in them. That's a private corporate thing between corporations and employees. That's totally separate. Options created by an exchange, that's basically two investors coming together, agreeing to a contract, corporations not involved. Now, options come in two flavors, calls and puts. Calls are basically buying the right to buy the stock at a certain price, and a put is buying the right to sell the stock at a certain price. So you could lock in a particular price for a specific period of time, but you pay sort of a premium to do that. And it increases your leverage, increases your possible returns. And again, there's a whole chapter on options. And options are, this is just to introduce you to the idea that options are there, not really get you to understand exactly how they work. They are complex and tricky types of securities, and most investors don't trade them. But options do open up a lot of possibilities for investors who are a little bit more advanced and want to take some extra risks and some extra leverage. Now, futures contracts are, again, a standardized agreement between a buyer and seller to make future delivery of a fixed asset at a fixed price. So say you're an airline and you're going to take, 1 million gallons of jet fuel you're going to use over the next 6 months. So you can make a futures contract to lock that price in. So your future purchases are exactly what you know they're going to be, and there's no speculation, there's no change. Just like if you went to a gas station and say, I want a contract or better yet, a home heating oil company. You say, I want a contract to buy home heating oil from you for the next year at $3 a gallon. No matter what the price becomes in the marketplace, I want to buy it at $3 a gallon. And what that home heating company would do, they'll come up with a package. You'll basically buy a future contract to guarantee the price in the future so they can make that offer to you. So it's a good faith deposit called margin that both buyer and seller to reduce the default risk, and they're going to hedge their risks for any price changes. So it marries up speculators with hedgers to protect their interests. And the future contracts, again, another complicated derivative that this chapter is merely to introduce you to the idea of it. Later chapters are to really describe it in detail. And actually, futures would be covered more heavily in the advanced investment course. Okay, so that is it for Chapter 2. Chapter 2 is a pretty basic, pretty quick chapter just to go over the basic financial instruments that we'll be talking about in this class and that you as an investor should know about for the possibility for you to invest in them at a future date. And it comes everything in a range of some things that are very safe to very risky. Here's a basic scale of risk and return. So treasuries, the 5-year treasury is the safest. Money markets are the safest, actually down here. Actually, I guess savings account would be the absolute safest. It would be really down here in the corner. The money markets are a little bit riskier. 5-year treasury is a little bit riskier. 10-year treasury is a little bit more riskier. High-grade corporate debt is a little bit riskier. Investing in S&P stocks, S&P 500 stocks is a little bit riskier. High-yield bonds are even riskier. Small stocks increases the risks. Real estate, looking at real estate over the last 10 years, we place that as even riskier. Then if you looked at options and financial futures, they'd be out here on the risk scale. So there's a scale of risk and return, and a lot of these instruments that we talked about in this lecture fall somewhere within that scale. So just wanted to give you a basic idea of bonds and stocks and financial futures, money markets and savings accounts, certificates of deposits. So this chapter is all about just going over the very basics of things that individual investors could invest in for the future. Later chapters will discuss more of these topics in depth, specifically stocks. So we look forward to that. Okay, thank you for Chapter 2, and I look forward to talking to you for Chapter 3.